This is certainly, hopefully, once in a century event, and it's important to focus on the long term and stick to your discipline. So, what we see being expressed is recency bias, both before and after enduring, and so staying close to your discipline, staying focused on the long term. It's really more of a reinforcement of what we believed, and it's good in times like this to relearn those lessons. We believe that it's really about the whole business. Just like you don't want to see your asset manager bolt on something, greenwash what they say they do, companies can't decide, on January 1 with a New Year's resolution that they're now ESG and voila, they're ESG. For companies like Autodesk, which is one of the companies we've owned for about 8 years, and this is true even for a company like Coca-Cola or for other companies, deciding to deliver products and services that meet E and S goals it can take a decade. You have to have a long-term investment horizon. As a business manager and as an investor, we have a long-term investment time horizon. In fact, our average holding period is over 8 years, and we have 7 companies in our portfolio we've owned nonstop for 14 and a half years. But it is about outcomes, and it needs to be integrated in the business model. What the company is doing, Deere with their precision agriculture, for example, it increases the top line because it's another component for their tractors. It's a competitive advantage because it's internally developed software, and it's a higher margin component, and it's yielding better environmental outcomes in terms of the use of pesticides, for example, as well as fertilizers. So that's going to improve the environmental outcomes and improve the business model. That is a true ESG solution, and we don't believe there is an E or S without very strong G. Our own process is to look for the high quality companies, sustainable long-term growth, but we only want to own them when they're selling at a significant discount to intrinsic value. And so for our portfolio overall, as of the end of last year, that discount to intrinsic value was about 47%. But certainly we are seeing in a cohort of names a definite investor fervor and sort of a herd mentality around the work from home names. And we see it as being a parallel to the run up to 2000. And there's a lot of parallels, not just in terms of the valuations. And the parallels are, for example, in 2000, the fervor was around .com names and the new secular driver of the internet highway and e-commerce and things like that. This was very true. Today, there is a new secular driver in the work from home stocks. And so when we look at the PE that I was talking to you about, for example, we see that the PE today, as of the end of the year, over the last 12 months, is about 125. At the peak of the bubble in 2000, which we mark at March 10th, 2000, PEs were 91. Right, and you can see the same thing happening in price to sales, about 31 in 2000 and about 28 right now. And if you track those highest performing stocks, there's about 200 stocks in our benchmark that are up 100% or more. And when you look at those types of the companies that had valuations like that in 2000, for example, you can go forward 1 year, 3 year, 5 year, 10 years, and those companies as a group are still giving negative returns. So even if there are great companies in that cohort that we would like to own, the embedded expectations in them is so high. And I'll just say one last thing. I was talking about recency bias. So, right now, those companies have experienced extreme growth. Is that going to be the same over the coming 5 years? And the question I would ask you, a year from now, 2 years from now, is your life going to look more like today or like it did, 14 months ago? It's not one or the other, but it's somewhere in between. And through our bottom-up valuation analysis, we can see that there is a group of companies with unsustainable, unrealistic valuations, somehow that will unwind. We don't know exactly how or when. So we see parallels between that as well as 2008, the financial crisis, but it's much more closely aligned, we think, to 2000. We're a growth manager, but the first thing we look for are the high quality characteristics. And ultimately, that means high barriers to entry. It's difficult, if not impossible, for someone to replicate this business. It doesn't matter how fast an industry might be growing, whether or not a company is competitively positioned to protect and grow their market share is the starting point for us. And then we want to look for that sustainable growth. And what we're looking for are secular drivers of growth. So we don't start by looking at the themes, we start by looking at the drivers of growth. And then the valuation is important for us, as I already mentioned. But when it comes to portfolio construction, we make sure we diversify by business driver, which again, you could say themes, but it's an outcome. It's not a starting point for us. So we make sure that we're not overexposed to any one particular business driver, and we limit it to about 15%. And correlation analysis shows that the 25 or so different business drivers to which we're exposed in our portfolio has really low correlation. We believe that where there is the most uncertainty, therein lie the biggest opportunities for alpha generation. So for us, in March and February, when the market was declining last year, we were looking at those companies in our library where the embedded expectations were so low because, again, the recency bias drove us to the fear and concern. And we bought Boeing and we bought Disney in March. We bought C-Trip in January. I mean, the decline in travel is unprecedented. Even 9/11, the planes were down for 4 days. But there's so much recency. If you do what we call expectations analysis, what would have to be true for this stock price to be correct? The embedded expectations were so negative that they were for these high quality secular growth companies. So that's where, the discipline for us is really bottom up. It's not a macro view, and it's very, very, very specific. What we're doing every day, for us, risk is on every day. It doesn't matter what the Fed is doing today or yesterday or tomorrow. Every day is a risky day because you never know when a correction is going to happen. And so we're allocating capital where we see the upside opportunity relative to the downside risk creates a 2-to-1 ratio, asymmetric to the upside, actively managing downside risk and trying to maximize the upside potential. And so when it ends, when the music stops, when the Feds change their mind, we don't know what it is. It's not part of our investment thesis. We're going to stick to, going back to my very first lesson, quality, growth, valuation. But there's a price to pay for having that downside protection. And over the longer term cycles, our upmarket capture and down market protection, there's no one that has our profile. Anyone with better upmarket capture doesn't have as good a down market capture. Anyone with better down market capture doesn't even break 100 on the upside. Our global strategy is slightly overweight to the US, but it's an outcome of the bottom-up stock selection, which, just to sound boring, high quality companies, secular growers, only those selling at a discount to intrinsic value. And so that's what drives our sector allocation. It's what drives the country allocation as well. We do have a library of about 180 to 200 names for our global, across our investment strategies, which is US as well as global and international. All of them meet our quality growth characteristics. Depends on where that valuation opportunity comes. There's sort of two categories of events that create buying opportunities for us. One occurred in the first quarter of this year. Since 2006, when we started managing money, there's only been one other exogenous market event, and that was 0809. We bought 6 companies, we sold 5 this year. That's a very high turnover for us. Typically it's 0, 1, or 2 in a given year. And so the other category of event is if something idiosyncratic happens to a company that can't be predicted. We actually bought NVIDIA at the beginning of 2019 because the Bitcoin implosion dried up a lot of their sales, and they had a big inventory overhang with their chips. But we understood from our analysis, we've been studying NVIDIA for a number of years, that the data center opportunity for the processing speed of graphical processing units, as well as continuing growth in the gaming and their leadership in that space, created a long-term opportunity and a great entry point. So our actual investments will be, the timing of the investments will be solely driven by valuation. We want to own those with the deepest discount to intrinsic value. The larger our position size, the deeper that discount to intrinsic value, which means our highest weight companies in our portfolio are the least risky. They have the least downside risk because of the deep discount and the greatest upside potential. So that's how we make that decision.